If you've ever looked at a company's balance sheet and thought, wait, why is this loan listed as current and that one as non-current? You're not alone. Today, we're breaking down current liabilities, one of the most foundational topics in financial reporting. In this lesson, you'll learn what makes a liability current, the difference between financial and non-financial current liabilities, how to measure, derecognize, and present them, real-life examples with journal entries, and finally, the key IFRS versus ASPE differences you need for your CPA exams. Before we dive in, don't forget to like this video, subscribe to Canada Accounting Insights, and hit the bell icon so you don't miss future tutorials. All right, let's dive in. Let's start with the basics. How do we know if a liability is current? Under IFRS, a liability is considered current if any of these apply. 1. It's expected to be settled in the normal operating cycle. 2. It's held for trading. 3. It's due within 12 months after the reporting period. 4. Or the entity doesn't have an unconditional right to defer settlement for at least 12 months. In simple terms, if it's going to use up short-term resources, like cash or inventory, in the near future, it's current. Now, if the timing of payment is uncertain, IFRS says to classify it as current unless you clearly have the right to delay settlement. Here's an example to bring it to life. Maple Leaf Furnishings, Inc. has a $4,000 revolving line of credit that it regularly pays off and draws on during the year. Even without a due date, it's part of the normal operating cycle, so it's a current liability. But under IAS 1, if the company can unilaterally refinance that loan for more than a year before the balance sheet date, it could classify it as non-current. Meanwhile, ASPE 1510 is a bit more flexible. It allows refinancing after year-end, but before the statements are issued to still be treated as non-current. Now that we understand what makes a liability current, let's explore the types, financial versus non-financial. Think of this as two categories of promises your business makes. Financial liabilities are obligations to pay cash or another financial asset. Non-financial liabilities are obligations to deliver goods or services in the future. Examples of financial current liabilities include accounts payable, notes payable, bank loans, dividends payable, taxes payable, and payroll liabilities. Examples of non-financial liabilities include unearned revenue, warranties, and customer loyalty programs. Once we know the type, the next question is, when do we actually record it? A liability is recognized only when three things happen. 1. There's a present obligation. 2. It requires an economic resource to settle, and 3. It results from a past event. Once those conditions are met, the liability is recorded at fair value plus or minus transaction costs. For example, Cedar Bay Corp. Signs a 1-year $50,000 loan at 6% on March 15th, but doesn't receive the funds until April 1st. On March 15th, there's no liability yet, because no cash has been received. Once the funds hit the account on April 1st, the obligation to repay exists. That's when the liability is recognized. Now that the liability is recorded, how do we handle it over time? Since current liabilities are usually short-term, they're rarely remeasured. But there are two key cases. If the liability is designated at fair value through profit or loss, it's remeasured at fair value, and any gains or losses go through the income statement. Otherwise, it's carried at amortized cost, meaning you simply adjust for things like accrued interest until it's settled. And once it's paid or cleared, that's where derecognition comes in. Derecognition means removing the liability from your books. This happens when the obligation is settled, like paying cash or delivering goods. The creditor formally releases you from it, or it no longer meets the definition of a liability. For most current liabilities, derecognition happens simply when you pay the bill or deliver the product. Now let's see how we show these on financial statements. Under IAS 1, current liabilities must be shown separately from non-current ones on the statement of financial position. Common line items include accounts payable, notes payable, taxes payable, accrued liabilities, unearned revenue, current portion of long-term debt. For straightforward liabilities like accounts payable, disclosure is simple. But for more complex items like warranties or customer loyalty programs, IFRS requires detailed note disclosures describing the nature, timing, and uncertainty of the obligation. All right, theory done. Let's bring this to life with some examples. Example number 1, accounts payable. Sunny Blooms Co. buys $2,500 of flowers on January 1st and pays January 31st. Entries: January 1st, debit inventory $2,500, credit accounts payable $2,500. January 31st, debit accounts payable $2,500, credit cash $2,500. Simple. The obligation exists the moment you receive goods on credit. Example number 2, short-term note payable. Borrow $10,000 on March 1st for 3 months at 5%. Entries: March 1st, debit cash $10,000, credit note payable $10,000. May 31st, debit note payable $10,000, debit interest expense $125, credit cash $10,125. Interest equals 10,000 times 5% times 3 divided by 12 equals 125. Example number 3, bank indebtedness, overdraft. If your cash balance goes negative, that's bank indebtedness, a current liability. Example: you start with $500, collect $5,750, and pay $6,800. Overdraft of $550. Example number 4, bank loan, current portion and interest payable. Loan of $45,000 at 5%. 6 months of accrued interest equals $1,125. Current portion of principal equals $5,000. Statement of financial position shows interest payable, $1,125 plus current portion $5,000. Total current $6,125. Long-term portion equals $40,000. Example number 5, dividends payable. August 31st, declare $2 per share on 1,000 shares. Pay September 30th. Entries: August 31st, debit dividends $2,000, credit dividends payable $2,000. September 30th, debit dividends payable $2,000, credit cash $2,000. Obligation starts at declaration, not at payment. Example number 6, taxes payable. Company earns $100,000, tax rate 25%. Entries: December 31st, debit income tax expense $25,000, credit income tax payable $25,000. March 31st, debit income tax payable $25,000, credit cash $25,000. Example number 7, payroll liabilities. Salaries $25,000. Employee deductions, CPP $1,226, EI $395, income tax $2,100. Employer contributions, CPP $1,226, EI $553, workers' comp $375. Entries: payroll, debit salary. Expense $25,000, credit CPP pay $1,226, credit EI pay $395, credit income tax pay $2,100, credit cash $21,279. Employer benefits, debit employee benefits. Expense $2,134, credit CPP pay $1,226, credit EI pay $553, credit workers' comp pay $375. Remittance, debit CPP pay $2,452, debit EI pay $948, debit income tax pay $2,100, debit workers' compensation pay $375, credit cash $5,875. Now let's look at the non-financial side. Example number 1, unearned, deferred revenue. Aurora Wedding Florals collects a $4,125 deposit, 75%, on a $5,500 wedding order. Delivery is in 2 months. Entries: April 30th, debit cash $4,125, credit unearned revenue $4,125. July 14th, debit cash $1,375, debit unearned revenue $4,125, credit revenue $5,500. Revenue is recognized only when the goods or services are delivered. Example number 2, warranties. Sold 2,000 plants at $25, cost $12 with an expected 10% replacement rate. 185 replaced this year. Entries: Estimate: debit warranty expense $2,400. Credit warranty liability $2,400. Actual replacements: debit warranty liability $2,220. Credit inventory $2,220. This is a non-financial liability because it's settled by replacing goods not paying cash. Example number 3, customer loyalty programs. When customers earn points for future purchases, that's a future performance obligation, a liability at the time of sale. Under IFRS, these are clearly covered by IAS 37 and IFRS 15. Under ASPE, they're not specifically addressed. Now that you know the journal entries, let's summarize the key differences between IFRS versus ASPE. Warranties. IFRS distinguishes service type, separate performance obligation, versus assurance type, estimated cost. ASPE doesn't use this distinction, non-financial liabilities. IFRS explicitly covers items like loyalty programs. ASPE leaves more to judgment. Refinancing. IFRS must refinance or have the right to defer before the balance sheet date. ASPE can refinance after year-end, but before statements are finalized. Measurement. Both use fair value plus or minus transaction costs, but IFRS guidance is more detailed. And here is a quick recap and cheat sheet for you. Current equals due within 12 months or within the operating cycle. Financial equals cash obligations. Non-financial equals goods or services owed. Recognize when there's a present obligation from a past event. Measure at fair value plus or minus transaction costs. Most current liabilities stay at amortized cost. Derecognize once settled or released. IFRS and ASPE are similar, but differ in timing and non-financial liability treatment. And this is all for today. If this helped you make sense of current liabilities, don't forget to like, subscribe, and share it with a fellow CPA candidate. See you in the next video.